Welcome to another video. In today's video, I want to talk about how to grow a small account to 100k using math, not using intuition, gut feeling, or some other random factor, but using actual math to increase your probability of success and reducing your probability of risk of ruin. That will be the aim of today's video. Before I start, I want to mention that we live in an era of prop firms. If you lack capital, your best bet is to take the prop firm route. Once you gain capital from prop firm payouts, then you can grow your personal. So if you're watching this video and you only have $100, $200, $300 to trade, do not put that in a personal account and trade. You're probably going to just blow your account and end up in the 95% of traders who never make money and who just basically donate their money to brokers. So do not do that. If you only have $100, $200, get a prop firm challenge or something and try to pass that prop firm challenge, and then the payouts from the prop firms you put in your personal account. Do not try to flip $100 or $200 account. Your risk of ruin is insanely high. Now, we're going to start with a $3,000 deposit. Anything less than a $3,000 deposit is suboptimal. Our goal is 100k. We're trying to grow our account to 100k. So the more the starting capital, the better. And I think that a $3,000 deposit is the lowest that you should go. That is just the bare minimum. If you can deposit 6k, 9k, 10k, even better. But worst case scenario, you should be depositing $3,000. That's what we're going to start with. And again, if you don't have $3,000, trade prop firms, get payouts until you have enough payouts that you can deposit in a live account to trade. So that is how you can start with this $3,000. So that's the bare minimum, a $3,000 deposit. The approach that we're going to take is simple compounding and risk adjusting. This approach will offer you the fastest route to 100k with, and I had to underline this, the lowest probability of blowing up. This is very, very important. A lot of traders, they approach growing accounts and so on, and they completely neglect the probability of blowing up your account, risk of ruin. They ignore that, and risk of ruin is the most important aspect when it comes down to trading. You don't want to neglect this. So the approach that I'm going to show you, it ensures that you have a very low probability of blowing your account. You want to take a $300k, a $3,000 account to a $100k account. You want to ensure that you take the route with the lowest probability of blowing up. You don't want to really just gamble and give away your money. You want to take an approach where the approach of losing everything is very low. Before I start discussing anything, there are a few things that you need to know and that is required to do this. First of all, you need to understand that this is extremely high risk. You could blow up, but this is mostly in the start. As we progress, you see that your risk of ruin decreases. But if you want to flip an account 300k, why do I keep on saying 300k? If you want to flip an account 3k to 100k, your likelihood of blowing up in the beginning is going to be very, very high, right? There's just no low risk approach to do this. You're going to have to take on substantial amount of risk. Number two, you need back-tested or live performance with a large enough sample size. This is extremely important. You cannot want to flip a $3,000 account into a 100k account and you have no data. You're going to end up in the 95% of traders who lose money. I'm telling you that right now. It is very important. Without this, you cannot properly allocate risk. And risk is very important. So if you have no back-tested data or live performance data with a sample size greater than 300 trades, I would not recommend attempting this. Already you have a very, very high probability of blowing up if you have no data on your system, strategy, portfolio, or anything. So those are the two important things. Understand that this is high risk, and understand that you need back-tested or live performance with a large enough sample size. Now, for this to work, we're going to assume that one, if you have back-tested data, it means that your backtested data isn't overfitted. And what I mean by overfitted, if you're a discretionary trader, you're probably not familiar with this, but when you backtest a strategy, it just tells you how a strategy may perform in the past. It does not dictate what may happen in the future. So when you overfit a strategy, you just fit it to the past, and when you trade the strategy in the live markets, you don't make any money. So that's what an overfitted strategy is. So I can show you my strategy, my portfolio performance. For example, here it assumes that it has made a total of 1,687% with a max drawdown of 44% and so forth. An overfitted strategy, as soon as this strategy goes into the live market, it will stop making money, it will lose money. So it cannot make money live, only in backtest. So we assume that your backtest is not overfitted. 2, your live performance will be within 20% of your backtested performance or your past live performance. So once again, here you can see our percentage return 1,687% with a max drawdown of 44%. So we are now assuming that in the future, our max drawdown and our returns will be very similar to our backtested performance. Like here, for example, you can see 2020, this strategy made 229%, 2021, it made 227%, 263%, and so on. So we're going to assume that this backtested performance is going to be very similar to the live performance. And next, lastly, and most importantly, you are extremely disciplined. You're probably watching this video and you're wondering when am I going to start talking about flipping the account, and you're probably here for the excitement. If you're still watching this video, kudos to you. But I have to mention all of these stuff because retail traders are so misled as to what realistic and good trading is. So I have to clear the air with all of these kind of like disclaimers or warnings or things that you need to approach trading with good risk management and a low probability of blowing up. So I have to mention these stuff. So I'm sorry if I'm boring you here, but I think this is the last one. So yes, you just have to remain extremely disciplined. As most traders know, you have to have a high level of discipline to do this. And the plan is very simple. The hard part is having a system that will work with this plan and then being able to stick with this plan. So I already have a system that I believe can work with this plan. The next part now is just to remain disciplined, and this is the part that I will be discussing in this video. So first of all, as mentioned, we're going to start with a $3,000 deposit, right? So I'm going to call this phase 1. So this is the first phase. We're going to start with $3,000 deposit in our personal account. And for this phase, the way that we're going to manage risk, we're going to assume that the worst case scenario, we're going to see a 80% drawdown. And the only way you can know if your worst case scenario can be an 80% drawdown is if you have back-tested performance and you have all of the data. So I have data on my strategies all the way from 2008, right? So I have an idea and I can use math to calculate what I can expect my drawdown to be. If you have data in your strategy, maybe you have it in Excel or some other spreadsheet platform, use that data to try and calculate your worst case scenario drawdown. So the way that I do it, I look at my worst drawdown. So based on this current portfolio, my worst drawdown was 44%. Then I run a Monte Carlo simulation, and my Monte Carlo simulation assumes that slippage, live trading conditions, some of the strategies overfitted, and things just will not work in my favor. And this is what the Monte Carlo simulation says. And it is saying here that I can expect in the worst case scenario to see a 82% drawdown. So if my math here is correct, there is an extremely low probability that I should blow my account in live trading, because my worst case drawdown should be 82%. And by the way, 82% drawdown is not easy to handle. So as you know, from a psychological perspective, this should happen, but I don't think a lot of traders can remain psychologically disciplined through an 82% drawdown. And this is why psychological discipline is important. So even though in the backtest we only experience a 44% drawdown, our Monte Carlo simulation tells us that we can expect an 82% drawdown. So this is the first phase. This is the type of risk that we're going to be using, and this is very, very heavy risk. And the target is to get a 200% return. So we're saying worst case scenario, we could lose 80%, and we want to flip this $3,000 account into $9,000 because 200% of 3,000 is 6,000 plus our initial 3,000 is $9,000. So we want to get a 200% return on this initial $3,000 investment. So based on your backtested performance, you should be able to see a timeline based on this performance, how long it will take you to get 200% return. My strategy tells me that with this amount of risk, I can make anywhere between 98% to 256% return a year. So that is the range. On the lower end, I can expect about 98%. On the higher end, I can expect about 256%. And if you look at the performance here, I made 220% in 2021, 263% in 2023, 100% in 2023. But overall, I can expect to make anywhere between this range a year. So based on my backtest and some of my live performance, I can expect to make this 200% return between 1 to 1.5 years. So 1 year and 5 months. So it should take me about a year and 5 months to turn this $3,000 account into $9,000, and that's a 200% return. And next we move on to phase 2, and this is when you see why risk management is important, because as you grow your account, you want to reduce the amount of risk. So in phase 1, we assume that our worst drawdown will be 80%. So worst case scenario, we're going to see a 80% drawdown. In phase 2, our account is now $9,000, so we can reduce risk, and we're going to assume that our worst case scenario is going to be a 60% drawdown. And I can simply just adjust my risk for this. So let's say I change my risk to about this amount. You can see that now my Monte Carlo is 59%, basically 60%. So now my drawdown, I can expect my worst case scenario drawdown to be 60%. Previously it was 80%. And obviously with this, as you reduce your worst case scenario drawdown, your returns also reduce. So previously, you can see that for the year, I could expect between 98% to 256%, but now my average yearly return has fell. So reducing risk also reduces returns. Increasing risk also increases return. But that's the purpose of this. As your account gets larger, you do not need to take on the same amount of risk. You can actually reduce your risk and still make a lot of money. So in phase 2, on our 9K account, we're going to assume worst case scenario 60%, and our target here is 100%. So once we get 100% return, we will move on to phase 3. And the timeline for this, based on my backtest, is again about a year. So I can expect to make this 100% return in about 1 year. And I can look at my returns here and see that 2023 was the only year I did not make 100%. In 2026 so far, and from April to May is live performance, by the way. This strategy is up 66% so far in 2026 with 2 months of live performance. So this is just telling me that I can expect to achieve this in maybe about a year, this 100% return in maybe about a year. And then once I achieve that 100%, I move on to phase 3, which my account balance will now be $18,000, which is 100% of $9,000. And you probably get the idea now. You target 100%, reduce your risk. Target 100%, reduce your risk. So now in phase 3, our account balance is $18,000, and our drawdown, we expect worst case scenario to be a 50% drawdown. Previously, it was 60%, but now we're expecting a 50% drawdown for the worst case scenario. So if I go over back to here and I reduce my risk, you can see that my worst case scenario now is about 50%. Once again, I reduce my average yearly percentage return but that does not matter because our risk of ruin is also reduced to 50%. So we just rinse and repeat. So in phase 3, we assume worst case scenario 50% drawdown, and the timeline here target 100% return, and the timeline here is 1 year and some months. So this could take anywhere between 1 year to maybe 1 year and 5 months. And as you can see from the returns here, in 2018 did not hit this target, 2019 did not hit it, 2023, so 3 years we did not get to this target, but other years we had 100% return. So we can expect to make this in about a year and 5 months thereabout, right? And that's phase 3. And rinse and repeat again. Phase 4, our account now, as you can see, 100% of 18,000 carries our account balance to $36,000. So you can see how we started off with a $3,000 account, and now in phase 4 our balance is at $36,000, and our worst case scenario drawdown is now 40%, right? So I don't really have to show everything against the same process, so we just reduce the drawdown so that we assume worst case scenario of 40%, we target 100%, and the timeline for this should be about 1.5 to 2 years. Phase 5, our account balance starts at 72k. Our worst case scenario max drawdown is 30%, and we target 100% return, and this should take anywhere between 1.7 years to 2.5 years based on our backtest. And then phase 6, once we get this 100% return, we will cross the $100,000 mark, and at this point you can really reduce risk massively while still earning a good percentage return per year. So what you can see here, once we reach this phase right here, which is phase 6, so again we just rinse and repeat, reduce risk, have our target. Once we hit our target, we reduce risk again and repeat. So in phase 6, our account balance is $144,000, and we have a max drawdown of, I just put 50%, but you could use whatever you're comfortable with. Once your account is greater than 100,000, you don't need to take on huge amount of risk again like you did when we started out. You can just say worst case scenario, I lose 15% of my account. So here you can see the Monte Carlo worst case scenario drawdown is 11%. So it is assuming that in the worst case scenario we may lose 11% on the account. But if you look at the average yearly return, is between 13% to 34%, and let's say on a 100k account, 30%, we achieve 30% in 2020, that's $30,000, right? In 2021, that's 29%, that's $29,000. So you can see that even though the returns are less, 15%, 13% here, 29%, 20%, that's still good returns. So the returns are less, but because the account size is a lot larger, that is still a good amount of money, right? $30,000, $35,000, even $13,000 in a lot of country, that is a lot of money. So here we're taking on small amount of risk, and we're making huge dollar signs. So that is the way that you can actually, and I genuinely believe that you can use to grow an account from a small starting balance to over 100k. And this is something that I actually plan to do, and as you know, I share everything on my channel, so you guys will probably see me do this in real time. So that is how it works in theory. So the full timeline for this growth is about 7 years. So all the way from your $3,000 starting balance to $144,000 will take about 7 years. So surprise, surprise, it's not a get rich quick scheme. So this may seem like this is a very long time and that this is not worth it, mostly because trading is marketed as a get rich quick scheme. You just find a profitable strategy and then in no time you can get rich quick. Unfortunately, that is not the case. So if you are able to successfully do this, which is grow your account from $3,000 to $144,000 in 7 years, this would easily put you in the top 0.001% of traders to ever exist. So understand that doing this is not an easy task. Marketing gurus and trading gurus will tell you that you can grow your $100 account into $100,000 in no time, but trust me, the math does not agree with that. That is not an easy task to do. The probability of that occurring is extremely low. So it is not easy to do, but it is possible. And this is the best way I see to grow a small account with good risk management, or I would say rather the best risk management, because when you're starting out, like, this is very, very heavy risk management. But as your account size increases, you see that your risk management gets a lot better. So if you want to reach faster than 7 years, so let's say you say 7 years, that's just way too long. I don't have the time to wait 7 years to grow my 3K account into over $100,000 account. Well, you have two options. You can, one, find a holy grail. So you just find a holy grail strategy. I don't know, maybe you can just buy courses, join signal groups, pay for mentorships until you eventually stumble across that holy grail strategy. So that's option one. Just buy a bunch of mentorship, signal group and courses from all of these Lambo gurus and hope that one of them have that holy grail. So unfortunately, obviously, that does not exist. A holy grail does not exist in the market. Number two, which is your more, I would say, realistic approach, is to take on substantially more risk. So again, we're achieving this with a relatively good amount of risk management. Like, our risk of ruin here is very low. Based on this process, if the backtest is not overfitted and live performance is to be similar to backtested performance, the probability of us blowing up is very low. It's probably well below 5%, right? So we're doing this with very good risk management. What you can do is just increase your risk substantially. So instead of like saying, I'm going to take this challenge and I want a low probability of blowing up, you can take this challenge with a lot more risk, where your probability of blowing up is much, much higher, but you can achieve a 100K account from a $3,000 account in maybe about 1 year or 2 years, right? So here is a scenario where I say I want to take on a lot more risk. So I'm using 20 times the normal amount of risk that I should be using. And what you can see is, well, without a doubt, your max drawdown in the past is over 100%. So you would have blown your account in the backtest based on this. Your Monte Carlo worst case scenario drawdown is 219%, and obviously that's not possible, because once you're down 100%, your account is blown. But what you can see here is that your average yearly return is between 261% to 680%, but you are almost statistically guaranteed to blow up at some point. Not almost, you are statistically guaranteed to blow up at some point in the time. So even though you can make 200 to 600% return a year, you are going to blow your account. So in 2022, you made 700%. In 2023, you made 260%. In 2024, you made 678%. But at some point in time, you are going to blow up, you are going to lose your account, and yeah, that will just happen. That is guaranteed to happen. So this is your second approach. You can take on substantially more risk, but understand that you increase your probability of just losing the account and not achieving your goal. So those are really your two options if you want to grow. If you want to achieve this faster than 7 years, find a holy grail, or you just take on substantially more risk. So in theory, to do what I just explained is simple. Like, it's really simple. That's really what I see the best way to grow and scale your account. It is simple in theory, but in practice, obviously, it will not be that perfect as it is in theory. And this is because of a few factors that may limit you, which is, one, as a trader, you may make withdrawal. So this phase here of growing from 3,000 to 144,000 assumes that you don't make any withdrawal. So in 7 years, would you be able to grow an account from $3,000 to $144,000 and not make any withdrawals? More than likely not. But if you make withdrawals, it affects the timeline here. So you will probably take longer to achieve this goal if you request a few withdrawals. this 7 years, it already assumes worst case scenario. In the best case scenario, you could achieve this in maybe about 4 years, 3 years, but the 7 years just basically assumes worst case scenario, right? And 2, the trader tweaks the system or changes plan during drawdown. So this is basically just not having enough discipline. So once you start experiencing a drawdown or the markets get tough, you start tweak the system, change your strategy, and deviate from what your backtest said and from what your system said the risk that you should use. So that can happen in practice. 3, market regimes can substantially change in a way that your backtest does not capture. So your backtest, again, it looks at past performance, and this does not guarantee that this will happen in live performance. So market regimes can change, and as a result, your backtest does not match your live performance. And 4, poor portfolio / strategy construction. So the way that your portfolio is designed could be poor if you're an algo trader, that is. So for example, I have this portfolio here. It has very low correlation, as you can see here, and so forth. So this portfolio is constructed really well. If you're like a discretionary trader, maybe your strategy, you choose the wrong strategy to do it if you trade only one strategy or whatever. I don't know what problems a discretionary trader could have. That's a whole different ball game. But if you're an algo trader, poor portfolio construction could be a reason, because obviously over this 7-year period, you will be changing your portfolio, switching things around, adding, removing, and so forth. And if you make some mistakes there that's poor, then that can result in you not seeing these returns. And there are maybe a few other factors, but those are really the main ones. But in theory, if you are able to execute this dispassionately, you should be able to achieve this in 7 years, obviously depending on the quality of your backtest and strategies and so forth. So based on my strategies, this is what it says will happen. And again, this is something that I plan to attempt in the future, and I share everything on my channel. So when I do inevitably start this, you guys will be able to see the journey and see me do all of this that I'm telling you in practice, in real time, and all of that stuff. So that was kind of the video today. I just wanted to share this idea here. If you're an algo trader or maybe even a discretionary trader, you can look to probably implement this idea if you're planning to grow a small account. So you get data on your system and then calculate your worst case scenario drawdown, and then adjust your returns and risk and so forth as you scale. So that's about it in this video. Peace and trade safe.